Hey, and welcome back to Happy Investors, this time with a new update on high dividend stocks. We're going to look at a total of 4 high dividend stocks that you'll definitely find interesting, with dividends around 6% and also potential for price increases. This is how you really become financially free and protect your wealth. That's what we're going to talk about. First, a quick update. My portfolios are starting to grow significantly. Some stocks are doing really well, like Carnival Corporation and a few others. If you're not familiar with us yet, subscribe to our channel. Every month we give an update on my own stock and ETF positions. It's my own money and there are winners and losers, but of course that's something you'll want to follow. That's interesting. We only talk about the things we're actually doing, no bad-mouthing or shady promotions. The first high-dividend stock you definitely want to take a closer look at is Banco Santander, with the ticker SAN. The international ticker is BSA. Now, Santander is a well-known bank, at least for us in the Netherlands. It might surprise you, but the bank is actually still relatively small in terms of market cap, with a market value of only about 11 billion. It pays a high dividend and also has price potential because European banks in general, are actually doing quite well and are in a good position. But of course, banks always come with risks. If we look at analyst ratings, the average price target is around 7.4. Now, the current price is 7.1, so it's trading more or less at fair value. That's why it might be interesting to wait for a small dip in the short term. However, Morningstar does give a lower fair value, so it's questionable whether the stock can really outperform. Keep this in mind with high dividend stocks. If you want to limit your risk, and with a bank, you always have cyclical movements. That's a major downside to banks. Looking at the historical valuation, the stock currently appears to be undervalued. Even if we look at, for example, 10 years or 7 years, the fair valuation is actually much higher due to EPS growth. But we also need to look at the normal multiple. So, what does the market normally pay for this company? Well, for banks, a price-to-earnings multiple of around 8 to 11 is already on the higher side. For that reason, Santander was available for a long time at a price-to-earnings level of around 6 to 5. Of course, you can also look at operational cash flow or free cash flow. Well, that's a low price, and naturally, you want to buy when stocks are low. But after a significant price increase due to changing sentiment, the price is now a bit higher. And of course, the question is it too high? The average multiple over the past 5 years was 6.5. However, I do dare to assume that we can, for example, aim for a slightly higher multiple, so a higher price that is still acceptable. Let's take the average from the past 10 years. Well, the current price-earnings ratio is around 8.7. Here we see the EPS estimates from analysts, and there are quite a lot of them. So let's assume that they are more likely to be right than we are as individuals. Then you could achieve an average return of about 10 to 11% per year. And that includes a high dividend of around 6%. What's better? Of course, it's best to wait for short-term price drops, but we'll get back to that in a moment. Maybe an even better idea. I personally have an ETF in Spain, and the Spain-themed ETF is actually doing quite well. Not only is Banco Santander in the top 3, but also 2 others, including Iberdrola. That's also an interesting growth company and fairly sustainable as well. And with that, you actually create much more risk diversification, and you have it. With the ETF, you don't get a higher dividend, but then you'll just have to occasionally take some profit from the price gains yourself. Valuations look interesting. The PEG ratio is estimated at 0.7. And that matches up with other sources, so that's interesting. We also see a strong buy here based on the factor analysis, and here too we see an estimate of the PEG ratio at 0.7. That points to possible undervaluation. The dividend is currently 5.3%. So it could go up a little. So count on 5 to 6%. The growth looks impressive. Revenue growth is quite high for a bank, with 15% growth estimated for next year. EPS is projected to grow long-term at a CAGR of 15%, so that's interesting. So apparently the market expects strong growth, and there's not just an opportunity for dividends here, but also for growth. But the transparency is a bit harder to determine for a bank, and this model isn't entirely comprehensive. But what we see is that the net income margin is remarkably high, and the return on equity is also very high, especially compared to the 5-year average. So that's a justification, a reason for paying a possibly higher price at this moment, but keep in mind that higher prices always mean more value risk. It just seems that this bank is experiencing strong momentum. Dividend yield is around 5%. The payout ratio is very low. The 5-year growth rate is very high, as you can see. So in that respect, it's also quite interesting in terms of dividends. In terms of short-term EPS revisions, it's rated as a hold, with the value being okay but not great, so there are definitely better bank stocks out there. Here, for example, you see an overview for inspiration. But not just these, there are many more. By the way, I myself have taken a small position in Barclays as a bank. Let's take a look at the sector. It ranks in the top 9% of the industry ranking and the top 50% of the sector. That's positive, a positive indicator. No further news on that front. Let's look at the short term a bit more. In terms of technical analysis, you can see a significant price increase of 150%. So the momentum is very strong, but we've already seen that. The fundamentals look good, and if you zoom out a bit, it could very well be that the stock goes even higher based on the all-time high. As I mentioned, the market value is only about 11 billion. That's not much. What could happen? Theoretically speaking, because the fundamentals look strong, we can see that there might be a resistance level here around the price level of 7.3. That's purely technical analysis, which I personally don't believe in. But yeah, there are people who do trade based on it. Is it possible that even if the fundamentals remain strong, there could still be resistance? That the price indeed rises sharply, drops sharply, but only for the short term. Suppose it's a dip of 10% to 20%. Then to me, that seems like an interesting entry point, considering the valuation is already attractive. The PE ratio is already low, so any short-term drop would be welcome as a great entry point for potentially higher returns. If you start dreaming about your high-dividend stock and it ever returns to its all-time high, which was before the financial crisis in 2007, then you'd be looking at about a 70% return. Don't count on that. Keep in mind that high-dividend stocks have relatively low growth, so a 5 or 6% dividend per year is already great. But there's also the chance of a small price increase over the long term, and if you end up with an average of 10 or 11%, then you're already doing extremely well. A super interesting high-dividend stock is Upbound Group. This is truly one of the best stocks among dividend stocks for the coming period. And I mean that seriously. I've also taken a position in it myself, and we've published it among our happy dividend stocks. Because Goop actually has the potential not only to pay out a high dividend of about 6% per year, but also has enormous growth potential. Basically, it has the characteristics of a good company, but it pays out a high dividend because of the really strong results we're achieving. Demonstrably, 100% demonstrably. Not many people can say the same about themselves. But this isn't about me, it's about you. What makes the ground group interesting? Why is this interesting enough to mention? Why did I take a position myself? Simply because the potential is enormous. But there are some serious risks when it comes to debt. Let's take a look at it step by step. First of all, the analyst ratings. Well, the current price is $26. The analysts give an average price target of $36, which means an upside potential of over 30%. There are 8 in total, so that's not too few. Morningstar rating, 5 stars. Their valuation is also much higher, namely $40. According to them, the uncertainty is a bit on the high side, and they indicate that this company has a small moat, in other words, little competitive advantage. What you need to know about this company, Ground Group, is that it basically has 2 major players, Mentor Center and Asima, and both are essentially a kind of lease-to-own concept. So check out the website, look at the holding company, and definitely check the investor relations, then you'll see for yourself what the concept is all about. But what's really interesting, and this is a growth catalyst, is that at the beginning of this year, they acquired Bridget. I'm probably not pronouncing it right, but Brigit, and that's a very interesting financial app that actually serves as a growth catalyst for the entire company. Now, the valuation is ridiculously cheap. Really, just cheap, and it's not without risk. But the chance that we'll get a return here is particularly high. And I don't say this often, because I'm very careful with my words. An investor always faces the risk of losing money, but here things just look really good, and it will probably disappoint. Who can say? But the upside potential is huge. The price-to-earnings ratio briefly dropped because of Trumpy and his behavior in April. Back then it dropped, now it's rising again, and I think this is a good buying opportunity. Why are we looking at that normal multiple? It's very low, as it is a financial stock, which, in a way, it is because of the loans. But the recent acquisition is going to be a growth catalyst that not many people see coming. The CEO has been retired since May this year, so that's still quite recent. The CFO from 2022 up until now has also become the CEO, and he's a heavyweight who, coincidentally, also worked at Santander, which was the first stop we mentioned here, but that's really just a coincidence. But he's a really sharp guy. He's been in finance for 20 years. GB, Morgan, and Santander. He was also a vice president there, so he's definitely smarter than us when it comes to finance, I'm sure of that. And he's definitely capable of managing the total debt and will probably achieve really good results with his financial company, which is basically what Ground Holdings is. Now, the upside potential if you use a multiple of 10.8. But let's be strict and take a lower one, 0.7. Below, we see the EPS growth estimates. They're not particularly high. I can agree with that. Then we could achieve an average return of 50% per year. Sounds extreme, but that's just the truth. This could actually happen. So the total return could end up above 100%, meaning more than doubling your money, and maybe even more than that. If we take a higher multiple, your money could indeed triple in about 2.5 years. Does this sound too good to be true? No. Just take a look at the results of our stock analyses. We've often managed to catch multi-baggers. Even within a single year, we've had stocks that go up 5 or 10 times. But on the other hand, we consciously select riskier stocks. And of course, there are losers too, so a stock can also turn out to be a big disappointment. But with Bound Group, I think they're going to do very well, but we'll see. And yeah, we'll really just have to wait and see. I've put my own money into it, so I don't know if it's the best investment, but I do have my own money in it and I believe in it. That doesn't mean you should copy me. This is not personal advice, and investing carries risks of losing money. But the valuation looks very interesting. So because of growth, the price-to-earnings ratio will go down, and it's already low. The PE ratio is estimated to be extremely low. The free cash flow yield is quite high, especially since 2021. That means you're getting a high yield just from the stock alone. And on top of that, there's also a dividend. So you don't see these characteristics very often. On factoring, they rate it as a buy. I wonder why not a strong buy, maybe because of the momentum, but that's going to increase. We see that the price-to-earnings ratio for next year is estimated at 7. Other metrics look good. The price-to-sales ratio is well below 1. You don't see that very often either. Price-to-sales is decent. Dividend yield is almost 6%, so it's a high-dividend stock. But what's the catch? Indeed, the debt. So the market cap is $1.5 billion. Well, it's small enough that not many companies or analysts pick up on it. Only, the debt is very high. But the EBITDA is such that the total debt relative to EBITDA is under 3, and usually that should be manageable, especially for a smart CFO who is now the CEO. The numbers look very good in terms of forecasts. It could all turn out worse, you have to be aware of that, but free cash flow growth of 18%, operating cash flow growth of 15%, while the stock is already cheap. Yes, it can. It can get worse. We do see bad ones come by. Margins will probably be able to improve, especially with the interesting acquisition they've made, which also benefits the other 2 larger companies that generate the majority of the revenue. Return on equity is starting to rise compared to the 5-year average. That's often a positive sign. If we look at the dividend yield, so for next year, a small dividend growth to 6% is estimated. The payout ratio is actually quite high, and we're even curious what would happen to the share price return if they didn't pay out any dividend and put everything into new acquisitions or company growth. But that's something, we'll see how the policy works out. The 5-year growth rate is also impressively good at 13%, and they pay out dividends every quarter according to the Zacks rank. As for quarterly revision updates, it gives a buy signal and scores an A for value and an A for growth. Well, you don't come across that combination very often. What I find interesting is what you see in terms of momentum. We already saw that in the factor analysis as well. But momentum is actually the only thing that often results from an interesting value plus growth. So if the PE ratio is really low, then it's just undervalued and it's often a no-brainer. I think this is a no-brainer. It's also in the top 4% of the industry rank and the top 50% of the sector rank. The price target from Zacks is 28, so that's quite a bit lower than the analyst ratings we've seen earlier from Wall Street. But this chart says it all. The current price is far below the EPS development, and this is exactly what Peter Lynch would like to see, and so should you. They give a number of reasons to buy: strong financial resilience. Kima or Kaima, however you pronounce it, I have no idea. What I do know is that it's just a decent company. It's actually growing quite fast. But here you'll find Widget, an interesting financial app that's going to be the right catalyst. There are also some risks, several, in fact. For example, the Mental Center, which currently accounts for a large part of revenue, isn't doing well, and there are a few more things you should look into yourself. Speaking of that segment, it's actually not doing so well. Yeah, it's basically been moving sideways since 2022. So if you got in from 2022 until now, more or less 2 years later, you wouldn't have made any returns. Though, there was a dividend. Now, there's a significant price increase happening because there was a dip earlier due to the overall market sentiment. After that, it went up sharply. At the moment, it's starting to rise significantly, and I got in at this price level, around 26. If we zoom out, we can see that it could easily return to at least the last sort of resistance level. And that's about a plus 20 to 40%. But maybe even further, up to that all-time high. Which would mean doubling our money, and all that with a high dividend on top. Still, just a quick disclaimer. I always say, I put my own money into this. I don't often see stocks like this in terms of composition, where I've mainly looked at the business strategy from a fundamental perspective and everything just looks good. But it could very well, and probably will, disappoint. I put my own money in, but this is not personal advice. You shouldn't copy my words and apply them to your own situation. I invest in an extremely risky way. Drops of minus 50%, 80%, or even 100% loss on stocks are part of the deal. That's the game. That's how I play it. So I deliberately invest smaller percentages, take on more holdings, and I simply let the winners run. And the losers? I cut those off early. Do you have any questions or comments about this company? Let me know. I'm curious to hear your insights. The third high dividend stock in this analysis is EPR Properties, with the ticker EPR. We've already mentioned this real estate fund several times in 2024 and 2025. The price return has already faded a bit. What we predicted has come true, high returns realized, plus a dividend of about 6%. But it can still be interesting for high dividend investors in the long term. Let's take a look at some details. Analysts do expect the price to drop a little. That doesn't necessarily mean it will happen, and I'll show you why in a moment. That's important, though. Morningstar's fair value estimate is 52 compared to a price of 60, so lower. But this isn't a quarterly report prepared by an analyst, but rather a quantitative report. So that's a bit less authoritative. Here we see a number of developments, and when we first mentioned EPR, it was 2024. Back then, it always had a relatively low price to AFFO. You can see it too. At that time, it was clearly undervalued, with the price, the black line, well below the fair value. After a significant price increase, as we said could happen, and it did, you can see that the potential has now become a bit less interesting in terms of price return. But we still have a dividend payout of about 6%, which is certainly not nothing. If we look at the valuation over the past few years, it was around 11. When we did the analysis, the price was much lower. That offers potential for price return. We just saw that with Upbound Group. It's fairly cheap, also has revenue growth, which is why it has a low PEG ratio. You should always look at the PEG ratio. Yeah, that just gives you the most interesting opportunities. It doesn't mean everything will work out, but if you strictly select for a low PEG ratio well below 1, you eliminate a lot of mistakes. That much I can at least assure you. Sometimes you also miss opportunities that way, because some good companies keep outperforming and seem to have a PEG ratio of, say, 2. But because they keep surprising, they just keep on growing. So that doesn't mean it's always true. Well, that price drop has increased. Here we see EPS estimates or good estimates from analysts. And the potential return could still be around 8% per year. So that's basically the minimum price return with a 6% dividend. Perhaps we could say here, well, maybe it will grow a bit more towards the earlier price to AFFO ratios due to strategic growth. For that, you also need to do more fundamental analysis yourself to analyze this real estate fund. What would that mean? Well, a potential return of around 12 to 13% per year. And that's actually surprisingly good for a real estate fund. Then we look at the valuation. What are we going to talk about in a moment? Yes, so that has gone up a bit. And this tool, Market Screener, is less suitable for that. Let's take a look at another tool. Actually, what we should be looking at is the price to AFFO. That's what we've been talking about the whole time. That is indeed estimated to be around 11.6. It's still below the sector average. Medium basically still means a discount of about 20%. So, putting aside the valuation of the company itself for a moment, here we're talking about relative valuation, and relative valuation is also a metric you can use where you see that it has a so-called 20% discount. But you always have to take that in the right context. Good numbers, nothing special really to mention. Profitability looks relatively good for APR, so that's a positive thing. We've also given a new update on top real estate funds for the next 6 months on our channel. Check out all the videos on YouTube for that. Follow us so you stay up to date with all stock analyses like this one. Dividend yield for next year is estimated at around 6%. That's of course high for a real estate fund, and they pay out dividends monthly. So that's why APR is also interesting for true dividend investors. Suppose you want to live off your dividends, for example in retirement or whatever, then here you have a stock that pays out dividends monthly and also gives you 6% per year. Keep in mind, high dividend stocks always come with risks. Growth is often limited and the downward movements can be significant. So ideally, you want to reinvest the dividends or at least use a more active strategy, active in quotes, where you buy more during major drops. Well, the stock has risen sharply and has broken through the imaginary resistance levels, as you can see. And now the price level is a bit higher. Maybe it's purely based on momentum, in other words, just the demand for the stock that keeps pushing it up, which could actually make it overvalued. It's possible it could break through to an all-time high, and then you'd still get a price return of about 20 to 30%. On the other hand, what we've seen is that the upside in terms of price return is pretty minimal, so don't expect too much from that. There's a good chance it will move sideways. That chance is there too, so what we see here is this. It could be long-term growth, but keep in mind there can be significant price drops in between. That's the downside with these kinds of investments. The price return even dropped by almost more than 75% at one point. That's obviously huge, and during the corona crisis it was even 80%. So those are massive price drops. And that's definitely something you want to keep in mind if you're going to use this as some kind of retirement investment or anything like that. These huge drops are exactly why people lose money, so you need to be mentally prepared for this. And it's exactly these massive crashes that are huge opportunities for long-term investors. If you buy after such a crash, a 100% return is nothing for this kind of stock, and as you can see, it's easy to get 170% or even 200%. But that only happens with long-term patience, and you have to play that smartly. Aegon is a well-known high-dividend stock on the Amsterdam Stock Exchange, which might just surprise us in the next 6 to 12 months. At the moment, Aegon, with the ticker AEG, even ranks number 2 within the insurance selection. And of course, they also do mortgages and pensions. So, what's interesting about this stock? Well, it's not just the high dividend. There might also be potential for long-term price growth. First of all, there's another update available on Aegon on their website. And yes, they're doing well with their share buybacks, so they've already completed about 150 million in share buybacks through March 2025. They've announced a new plan, namely another 200 million in share buybacks for at least this year. And maybe even more will follow. They're also building momentum in their strategy, especially in America. Check out the full update for more on that. In particular, the number of licensed agents has increased. Well, Aegon does more than just insurance. Of course, they also do mortgages and pensions, a bit of asset management as well. All in all, it's definitely not a great stock, so don't expect too much in terms of price movement, but the dividend is around 5 to 6%. Maybe hold on to it. These share buyback programs are always good for the valuation, which will become cheaper as a result. But 200 million on market value of 10 billion is only 2%, so it's not exactly earth-shattering. Keep that in mind, of course. The fair value estimate for Morningstar is $7. Here we'd used a different ticker for the data. So don't be surprised by euros and dollars. The current price is 7, so according to Morningstar it's roughly at intrinsic value. We find the ratings. Wall Street analysts estimate a potential price increase of about 9 to 10%. Note, it's only 2 analysts, so not a lot. If we look at this bit of historical valuation, it does seem like this stock could be interesting again, maybe to rise a little. But that probably won't be a whole lot. The current price to earnings ratio seems very high right now, but for next year it's estimated at a PE of 10. This matches up with other sources we've checked as well. And how is that possible? That EPS growth has been estimated very high by quite a few analysts. In total, 10 analysts are predicting an EPS growth of 10% to 100%. Well, that's a doubling, that's a lot. And by the way, Aegon is coming out of a rough period, as you can see. If this trend continues, especially with the growth estimates for 2026 and 27, and we use a normal multiple, which is at 10.5, more or less in line with the 20-year average, then, theoretically, you could achieve a return on this stock of about 28% per year on average, or 9% in total. Of course, that's a very optimistic estimate. Keep in mind, it's definitely not just going to happen like that. But there are a few interesting insights. The price-to-earnings ratio for next year is estimated to be around 10 to 11. Now, EV to sales and price to sales aren't notably high. Other factors are less attractive, though. For example, the price to cash flow is a bit higher. The dividend yield is currently around 5%. The market value is around 10 billion. Keep in mind, they do have some debt. By the way, it's in dollars, as you can see. The debt level might be a bit high, but of course, that also has to do with their business model and cash flow. That's why further research is needed for these kinds of stocks, to check the balance sheets, of course. And it really is a specialized skill to assess the risks involved. So, at the moment, it ranks number 2 among all the life and health insurance stocks listed here. You also see another familiar name from the Dutch stock market, namely NN Group. Also a high dividend. It also seems to be in a good position, but currently gets a hold rating due to its high valuation. For example, we announced Manulife Financial in our stock analyses on Happy Investors in 2023. We achieved a high return, 60% in the following 12 months. But the stock is still interesting. However, as you can see, this factor analysis is somewhat mixed, so keep in mind that everything we present is purely for inspiration. In terms of growth, it doesn't seem all that interesting. These are probably estimates for 2026. Again, 6.8%. That more or less matches what we've seen here in this data source. Dividend growth is actually quite high. I'll talk a bit more about that in a moment. Profitability doesn't seem very attractive because it simply isn't. So there's definitely work to be done here for management. Especially the profit margin is much lower than the sector median, so the question is what's going on here. But the sector median, of course, includes other types of companies as well, namely top financial stocks. So that's a different sector too. And that's why you really always have to compare Aegon with all the other insurance companies out there. And not just from America and the Netherlands, but also from Europe and Asia. And that, well, that takes a lot of research. If you actually want to pick the best stocks from that sector, well, as you can tell, that takes a lot of time. Aegon has had dividend growth for 3 or 4 years in a row and has been paying dividends for 12 years already, but actually much longer, as you can see. There was just an interruption, of course, around the financial crisis, so actually it was a stable dividend company, and in the past the dividend was a bit higher, as you can see. But overall, the dividend growth is, for example, not very remarkable. We can take a quick look at it. Dividend growth for next year is estimated at about 6%. Admittedly, that's higher than the sector, so there's that. But dividend growth over the last 10 years is only 3%, so it's not a great dividend stock in terms of growth. But then, what can you expect? The dividend is already 5 to 6%, so it's already a high dividend stock. And with high dividend stocks, you mainly want to focus on the downside potential. What are the risks you might face? Often, you choose high dividend stocks if, for example, you're approaching retirement or already retired. Then, of course, you want to receive high dividends to cash in. Keep in mind, though, that you pay dividend tax. That aside, you still need to be aware of the potential downside pitfalls. So definitely compare Aegon with its peers as well, Global Life, Pramerica, and MSC, which we just discussed, those kinds of companies. So from a sector perspective, there is actually a sell rating for the short term. Interesting. We can see their price estimates here. Those are actually a bit lower than the current price level, which, according to their sources, is now at the price level of 2021. But of course, there are several sources we've seen in this analysis. Price to earnings is estimated here at 7 for next year. Here we also see a comparison with a number of peers. By the way, we also see that down here, for example EverQuote, which was mentioned in an earlier analysis at the beginning of this year. The stock, being a small cap, moved quite volatilely. Not really comparable to Aegon, but you do have a lot of choices within this sector and all the other sectors. If we zoom out, it looks like Aegon still has a long way up to go. But of course, it's a completely different company now than it was in, say, 2000 or 2007. What matters is today, and that's why the stock scores is interesting on factor analysis. It could be that the valuation could get even better.